Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
$5.46. That was the closing price of Momentus Inc., ticker MNTS, as of yesterday, February 11th, 2026. We saw an intraday high of $5.94 and a low of $4.95. Now, that's a massive swing for a single session, but honestly, if you're just focusing on the price action, you are missing the real story here. The real story is the volume. On February 9th, just a few days ago, over 32 million shares changed hands.
And let's be incredibly precise about what 32 million shares actually implies here. The float, the total number of shares actually available for trading, is only 1.39 million. So we are looking at a turnover rate of roughly, what, 2,300% in a single day? It defies fundamental logic. That isn't investing. That's a chaotic game of musical chairs played at light speed.
Or if you look at it through my lens, what we're looking at is a massive, violent repricing event. We're looking at a company sitting at the precise intersection of a booming space infrastructure market and a balance sheet that, I admit, is on life support. But the central tension here is undeniable. Momentus is capitalized at barely $8.4 million today, yet they hold a seat at the table for the Missile Defense Agency's $151 billion SHIELD contract. So the question we need to answer is simple. Is Momentus a, quote, technology-rich, capital-poor, asymmetric opportunity that's primed for a 50x return?
Or is it a bankruptcy candidate with an Altman Z-score of -37? I mean, that is the number that keeps me up at night. You see a lottery ticket, I see a structural financial disaster. This is a company operating under a going concern warning with shareholders who have, for all intents and purposes, revolted against further dilution. The technology might be fascinating, but the equity looks uninvestable to me.
I see why you think that. And the balance sheet is ugly, no doubt about it. I'm not going to sit here and tell you it's a fortress, but let me give you a different perspective on the thesis here. Momentus represents a classic disconnect between operational reality and market valuation. As of right now, the market cap is less than 4% of what this company commanded during its SPAC era peak, and yet operationally, they have secured their most significant strategic wins to date.
Strategic wins is a very heavy phrase for a company that has burned, 91% of its value in fiscal 2025 alone.
Just hear me out. The evidence is in the contracts. Selection for the Missile Defense Agency's SHIELD contract is not a minor press release. This is a $151 billion IDIQ vehicle. Even if Momentus only captures a fractional amount, let's just say 0.1%, that implies revenue multiples that are significantly higher than the current market cap. And it's not just promises. Look at January 2026. They received $1.9 million in contract payments from NASA and the Air Force Research Lab. They are executing, and more importantly, the government is paying them.
I'm sorry, but I just don't buy that $1.9 million is enough to turn this ship around. Let's look at the solvency crisis. As of December 31, 2024, Momentus had $1.6 million in cash. Their quarterly losses run between $10 and $15 million. You don't need a PhD in economics to see that the math just doesn't work. They're burning the furniture to keep the house warm.
That's a static view of a dynamic situation.
It's a realistic view of insolvency. Liabilities exceed assets, with a negative price-to-book ratio of -6. And let's talk about the shareholders. On February 6th, at the special meeting, the shareholders rejected Proposal 4. That proposal would have increased the authorized Class A shares. By rejecting it, they created a dilution ceiling. Management literally cannot issue the shares they need to raise the capital to plug that $15 million quarterly hole.
I would frame that a little differently. That vote forces discipline. But let's step back. You're focused on the financial engineering of the past. I want to talk about the forward-looking reality of the order book versus that balance sheet.
I'm happy to talk about the order book, provided we look at the reality of it.
The reality is that analysts are projecting, and this is based on the data, an estimated revenue of $167 million for 2026. Now, I know you're going to scoff at the jump from the trailing 12 months revenue of, roughly 1 million. But in aerospace, revenue is milestone-based. It's lumpy. The Vigoride 7 mission, scheduled for March 2026, is the trigger.
The trigger for what exactly?
It unlocks deferred revenue. It unlocks task orders. Vigoride 7 is fully booked. They are flying payloads for DARPA, for NASA, for the Department of Defense. This isn't some test flight with dummy weights. This is the revenue-generating mission that validates the platform for the SHIELD contract. Once that bird flies in March, the revenue recognition changes overnight.
That is an incredibly dangerous assumption. You are banking on a Herculean leap greater than 15,000% growth year over year to justify the current valuation. That is statistically improbable. And regarding the SHIELD contract, let's be precise. It is an IDIQ, indefinite delivery, indefinite quantity. In government contracting terms, that is a hunting license. It is not a check.
It's a license to hunt in a $151 billion forest.
A forest filled with 2,400 other hunters. They are competing against Blue Origin. They are competing against General Dynamics. These are companies with billions in capital, not 1.6 million. Momentus needs immediate liquidity just to survive long enough to write the proposal for a task order. You are suggesting they can sprint a marathon while bleeding out.
But they offer something Blue Origin doesn't. And this brings us to the technology risk and the operational history. The Vigoride orbital service vehicle isn't just another tug. It uses water plasma propulsion, the microwave electrothermal thruster, or MET.
It's unique, I'll give you that.
It's safer. It's greener. It completely removes the hazards of hydrazine. This positions them perfectly for the industrialization of space, where safety and sustainability are becoming regulatory requirements. And the platform is mature. Vigoride 5 in January 2023 had 35 successful firings. They've proven the physics works.
Have they, though? Because I come at it from a different way. Early missions like Vigoride 3, they were partial failures. Vigoride 6 had an inclination error. It put satellites in the wrong orbit. In this industry, you don't get points for mostly getting it right. If you drop a client's payload at the wrong inclination, you have failed. Period.
The Vigoride 6 inclination error was minor compared to the Delta V maneuvers they successfully demonstrated. They changed orbital planes. That is incredibly difficult. And look at the innovation pipeline. On Vigoride 7, they are flying a 3D printed fuel tank developed with Velo 3D. This shows they can scale manufacturing. They aren't just building prototypes by hand anymore. They are moving toward mass production.
Mass production requires capital, which brings us right back to my primary point. Compare Momentus to, say, Rocket Lab. Rocket Lab has a market cap of over $40 billion. They have $555 million in revenue. They are the factory. Momentus is trying to be a mechanic working out of a garage that's being foreclosed on. Why would you bet on the risky mechanic when you can own the factory? Reliability is the only currency that matters in space, and Momentus has a mixed record facing a binary pass-fail test in March.
Because Rocket Lab is priced for perfection and Momentus is priced for death. That's the asymmetry. If Vigoride 7 works, the repricing isn't 10%, it's 1,000%.
If it works, and if they can pay for the launch, which leads us to the governance and capital structure crisis we touched on. You mentioned the volume earlier, 32 million shares on February 9th. To me, that just screams instability.
I disagree. I think that volume indicates a clearing event. The weak hands, the people who held from the SPAC days and were down 99%, they are out. That 32 million share turnover means the shareholder base has completely rotated. New capital is entering. Speculative capital, yes, but capital that believes in the current price point, not the old valuation.
Or it's a retail frenzy driven by day traders. The stock gained 81% in 2 days back in January. That is not institutional accumulation. That is gambling. And regarding the rejection of Proposal 4, you called it discipline. I call it a death knell. Without the ability to issue more Class A stock, they lose their primary survival mechanism. How do they fund the next quarter? They can't sell equity.
They fund it through non-dilutive financing. They fund it through contract advances. The rejection of Proposal 4 forces management to stop diluting shareholders and start closing deals. It aligns their incentives with ours. They have to make the business work now. There is no safety net.
That is a terrifying operational constraint. It's like telling a diver you're cutting his air hose so he learns to breathe less. The Altman Z-score predicts bankruptcy with high accuracy, and at -37, the model is screaming.
Models look backward. Markets look forward. Let's talk about the 10-year horizon and expected value. This is where the math actually supports a buy, even with your bankruptcy risks.
I'm listening, but I am very skeptical.
The orbital transfer vehicle, OTV, market is growing at a 13.4% CAGR. Momentus is a pure play on satellite servicing and debris management. Now let's do a quick expected value calculation. Let's say there is only a 20% chance, just 1 in 5, that Momentus survives and captures a tiny slice of that market.
20% feels generous given the cash position.
Even at 20%, to get a 5x return from here, the valuation only needs to reach roughly $45 million. That is less than 4% of its peak valuation. If they survive, a $45 million market cap is laughably low for a company with flight heritage and government contracts. If the company survives, it's not a $45 million company, it's a $300 million company. That's a 30x return. So even if you weigh the bankruptcy risk at 80%, the expected value is positive.
That is a classic gambler's fallacy. Expected value calculations fail when the probability of zero of total capital loss is the dominant variable. You are asking investors to ignore the 80% chance they lose everything for a lottery ticket.
Venture capital is entirely built on that math.
But this isn't a private VC round. This is public equity. And look at the macro picture. The space infrastructure market is forecasted to hit $373 billion. Who captures that? The giants. SpaceX and Blue Origin are vertically integrated. They launch the rockets, and they are building the tugs. They will squeeze out niche providers like Momentus, who have bad balance sheets. Why would a customer hire Momentus when SpaceX offers the ride and the service in one package?
Because of the niche. Water plasma. It's about the specific orbits, the specific delicacy required for certain payloads that chemical propulsion can't handle. And the government wants diversity. They don't want a SpaceX monopoly. That's why SHIELD has 2,400 awardees. They need Momentus to exist.
They don't necessarily need Momentus Inc., the corporate entity, to survive. A defense prime could pick up the IP out of bankruptcy for pennies on the dollar. That's the real risk here. The tech survives, the shareholders get zero.
That's a fair point, but it ignores the friction of bankruptcy. The government wants continuity. The payments in January prove they are willing to support the current entity.
$1.9 million is not support, it's accounts payable?
It's proof of life. Look, I'm not saying this is a savings bond. I'm saying it's a mispriced option. And that brings us back to March, the Vigoride 7 launch. This is the binary event.
On that, we absolutely agree. It is binary. So let me just summarize my position. I acknowledge the technology. The water plasma propulsion is fascinating science. But Momentus is a financial zombie. The rejection of the share increase, the reliance on these warrant inducements, it all signals the end of the road. I view Vigoride 7 not as a catalyst, but as a final gamble, a desperate Hail Mary.
And I see why you think that, I really do, but I'm convinced the mark is missing the asymmetric reward. The company has cleared the regulatory hurdles. They have NASA and defense contracts in hand. The hardware is physically on the pad for March. If Vigoride 7 succeeds, the repricing from insolvency risk to growth company will be violent and it will be rapid.
It will certainly be violent. Whether it is violent to the upside or the downside, well, that remains to be seen.
And that is where we have to leave it. The definitive answer isn't in our debate. It's sitting on the launch pad.
Precisely. Investors need to watch the SpaceX Transporter 16 mission in March. And more importantly, don't just watch the launch. Watch the subsequent 8K filings.
Exactly. We need to see if that paper backlog becomes real cash, real task orders. Until then, I'd say fasten your seatbelts.
It's going to be a bumpy ride.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.